Lower interest rates, I think, may seem somewhat opposite to intuition, but I think lower rates helps gold. I think there are a lot of cross currents out there that are going to help gold. But more than anything else, technically, gold broke out, as you know, got above that, 4 tries at 2100 or wherever it was, broke out and had a nice run, and then has, consolidated for a couple months at a high level. And I think it's ready to break out again, or get out of that consolidation. I think the next run is probably going to be right to 3,000. So I think both technically and fundamentally, it's got support here.
DavidHunter, the renowned macroeconomist and chief macro strategist at Contrarian Macro Advisors, stands out with his optimistic forecast. Hunter envisions gold potentially reaching $3,000 per ounce this year, while setting ambitious targets for silver at $60, with a possibility of surging to $75 if it breaks through key resistance levels. Complementing this view, Michael Oliver of Momentum Structural Analysis anticipates the end of the current consolidation phase for both metals, followed by an acceleration phase. Oliver draws intriguing parallels to previous bull markets, where gold saw 8 to 10-fold increases over a decade. Several factors underpin Hunter's bullish outlook. He predicts U.S. interest rates may decrease more rapidly than in other countries due to Federal Reserve action or economic deceleration. Contrary to conventional wisdom, Hunter suggests lower interest rates could benefit gold. Recent economic data supports this view. The latest inflation figures are likely to be welcomed by Fed policymakers, who have sought sustainable progress toward their 2% inflation target before considering interest rate cuts. Most economists anticipate rate cuts could begin as early as September, potentially leading to lower borrowing costs for consumers and businesses. Hunter also points to geopolitical uncertainties as a driver of safe haven demand for gold. Moreover, he highlights increased central bank buying, particularly by China and Russia, and gold's recent technical breakout above previous resistance levels as supportive factors for his bullish stance. Interestingly, recent data from Statista shows China's leading global gold mine output in 2023, with Russia tied with Australia for second place. This production dominance, coupled with these countries' gold-buying sprees, suggests a strategic accumulation of reserves that could further tighten global supply. Join us as we delve into DavidHunter's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
Believe it or not, I'm very bullish gold near term. I mean, I think you can see 3,000 has been my target for a long time, but I think we can see 3,000 this year. I think you can see 60 on silver, and I've said if it gets to 60, it may push through and go to 75. So those are big runs, and I think what we've had in the last month or 5 or 6 weeks of consolidation, I think is setting us up very soon for a big rally. And so I think we have a strong summer in the metals. The miners, which have lagged, I think will finally start catching up too. I really believe, and it hasn't come to fruition yet, but I really believe we're staring at a very weak dollar ahead. It's hung in here. It started to break, I don't know when that was, a year ago, and then turned around and had this very long counter-trend rally where it's gone up, come down some, and gone up again. I really think we have a weak dollar ahead. The problem is Japan's been stubborn in terms of changing their policy, but I think it's a matter of time for them. I mean, they're defying logic in terms of printing money like crazy and being able to keep interest rates close to zero. That's just not. We saw what happened here in 2022. When it breaks fast, and I think Japan's very close to a reversal in the yen, so not by choice, but I think rates are going to start pushing up there. My read of the euro is that the euro is going to rally. Canadian dollar, Australian dollar look poised for rally. So I think the dollar is going to come under pressure. Part of it is going to be, I think, that our interest rates come down faster than some other places. Whether it's Fed induced or whether it's just our economy is going to start decelerating pretty fast. I'm not sure yet, but I think that's all playing into, weak dollar obviously will help gold quite a bit. Lower interest rates, I think, may seem somewhat opposite to intuition, but I think lower rates helps gold. So I think you got both of those coming here. And at the same time, you still do have plenty of things around the world to get those that want to look at gold as a safety or a place to run. You got the geopolitics out there that is going to add to that. You've got central banks, particularly China and Russia, buying up gold, looking to back their currencies perhaps. So you've got I think there are a lot of cross currents out there that are going to help gold, but more than anything else, technically, gold broke out, as got above that, 4 tries at 2100 or wherever it was, broke out and had a nice run, and then has consolidated for a couple months at a high level. And I think it's ready to break out again, or get out of that consolidation. I think the next run is probably going to be right to 3,000. So I think both technically and fundamentally, it's got support here. In both gold and silver, you've had very little institutional sponsorship, and if they start performing here, pretty thin markets or not very big markets, particularly on the minor side, that if institutions decide they need to have 5% of that in their portfolio and they start copying one another, it doesn't take much to drive these prices up.
In a world increasingly burdened by debt, economic experts like DavidHunter are sounding alarms about the potential for a severe economic crisis, even in the face of a mild recession. The global financial landscape is navigating uncharted waters, with debt levels reaching unprecedented heights. According to a recent Institute of International Finance report, the world is grappling with a staggering $315 trillion in debt. This monumental figure represents the culmination of the fourth and largest debt wave since World War II, a trend that began in 2010 and accelerated dramatically during the COVID-19 pandemic. To put this in perspective, the last time global debt reached such alarming levels was during the Napoleonic Wars, over 2 centuries ago. Hunter paints an even more sobering picture of the future. He projects that global debt could balloon to an astonishing $450 to $500 trillion by the end of this decade. He anticipates that most of this increase will occur in the early stages of the next economic cycle. What makes this situation particularly precarious is the historical precedent. Each of the previous 3 debt waves since World War II has ended in economic turmoil. Let's get back to the interview.
We are able to have, a recession, not just a soft landing, a recession, but it doesn't turn into a crisis like we had in 2008-9, and it doesn't. What I keep saying is we've got that 320 trillion in debt, and we've got quadrillions in notional value of derivatives, which is leverage on markets or leverage on securities. Those are 2 forms of leverage, debt and derivatives, that are at levels that are way beyond anything we've ever seen before, even way beyond 2008-9. If we get a slowdown that turns into a recession, my assumption is what that leverage does is it really breaks things. It exacerbates whatever it is. That's why I'm calling for a bust, is that if in some way we're able to skate through that and have a more normalized recession, then I think Trump's policies are obviously very much more what we want to see. I think you can lower taxes, control regulation, and all of a sudden economies can be efficient again, and you can generate a lot higher GDP, et cetera. So I think that would be the hopeful side of it. I think it's a low probability, and it's not because I think Trump's wrong. It's because I think the bust happens no matter who's president in their first year. And neither one's going to have any ability to control that. It basically, we got to save the system. Here's what you got to do. And once you get into that massive ramp up in both money, monetary expansion, and fiscal expansion to save the system or to bail the bust out, it becomes not 34 trillion in debt, but probably double that. Because if I'm talking, or almost double that, if I'm talking about 20 trillion in money, you'll see a similar amount of new debt coming out because they'll be coming up with any program they can to kind of goose the system. So it's, we're at, let's say, 320 now in global debt. I suspect by the time we get to the end of the decade, most of it happening in the first part of the next cycle or in the bust and the year after, I think you could see global debt up closer to 450 or 500 trillion. So if 320 is off the rails, what's 500? And again, it'll then have to be serviced at rates that are, because I think next year you could see a 0% 10-year because of the monetization of the debt. They'll be buying up every bond they can. So you could have for a little while, they'll be thinking, well, we can service this because rates are low. We'll keep rates low. Once inflation ramps up, it's going to ramp up very fast. All of a sudden, like I said, you're going to be looking at 15 and 20%, not only T-bills, but long bonds. And there's just nothing they can do to service debt. And the debt's going to be double what it is now. So I just don't know how that equation leads to anything but a disaster. 2008-9 led to a much bigger excess, to try to bail that one out. And now we've squandered that opportunity, and we're right back into something that could be far bigger than that.
In light of the unprecedented global debt situation and the possibility of a severe economic downturn, how might gold's role as a safe haven asset and potential hedge against financial instability evolve? And what factors should investors consider when evaluating gold's place in their portfolios for the coming years? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.